Okay, so let's dive into this deep dive into British American Tobacco, or BAT, as most folks know them. This one was requested by a listener, and I can definitely see why. They're sitting on a dividend yield of 8.1%. And just for context, that's over 3 times the market average right now. But we're not just looking at the surface level stuff today. We're going to dig into this Motley Fool article we found that takes a close look at their next 5 years. Try and figure out, is this company a hidden gem? Or are we looking at a potential trap here?
Yeah. High dividends, they're tempting, for sure. But like you said, gotta look deeper, especially with a company in an industry like tobacco.
For sure, right. So to get everyone on the same page, BAT, they're a global giant, really, when it comes to cigarettes. Big brands, sold all over the place. Everyone's heard of them. But here's the catch. Cigarette sales are dropping. And we're not talking about a small dip. This is serious. We're looking at it like 5% year over year. And honestly, it could even get worse.
Yeah, and when you think about the scale, it really hits home how big of a deal that is. This article, it highlighted that just in the first half of this year, 2024, BIT sold 250 billion cigarettes. 250 billion. Imagine a 5% drop on that. That's a whole lot of money disappearing.
Yeah, no kidding. It's kind of mind-boggling when you put it like that. But BAT's not just sitting around watching everything go up in smoke, so to speak. They're making moves trying to break into what they're calling new categories, things like vaping and smokeless tobacco. Seems like a good idea at first glance, right? Trying to keep up with the times. But is it really all it's cracked up to be?
Well, that's what this Motley Fool article digs into, and it's not as straightforward as it might seem. Like, they have these modern oral pouches, and those are doing pretty well. But the rest of this new category stuff, it's barely making a dent in their overall revenue. It's almost like trying to, I don't know, fill a swimming pool with a teaspoon. It's just...
Okay, that's a much better analogy. Much better than mine. I like that. All right, so we've got shrinking cigarette sales. We've got this diversification strategy. That's still pretty young, we'll say. So let's bring in the big question, that massive 8.1% dividend yield. It's tempting, no doubt. I mean, I get why our listeners are interested. But this article, it suggests that this could actually be a warning sign, especially for investors who are, a little more risk averse.
It's a really important point, for sure. When a company is offering a yield that's that much higher than the average, it can be a sign that they're having trouble attracting investors the normal way, especially when their main business, like you said, is on the decline. It's kind of like offering a huge discount, right? You only do that when you're desperate to get people to buy.
Yeah. So not necessarily a sign of strength then, maybe more like a sign of desperation even. It's not just about getting a quick return. It's about understanding what that return really means.
Exactly. Like, imagine you're at a store and there's something you like marked down 80%. You'd have to wonder, what's wrong with it, right? Why is it so cheap? Same logic applies to stocks. That big dividend, it might look good, but you got to understand what's behind it.
That's a good way to put it. Really gets you thinking. So should you be running towards Bete or running away? It's tough to say. It's not a simple yes or no. This article pointed out that if you're okay with high risk, you want to get those quick gains. Then maybe Bete's worth a shot. But if you're in it for the long haul, want that steady growth, then this might not be the right fit.
Yeah, it all comes down to your personal style, right? Like, what are you hoping to get out of this? If you're the type who likes to roll the dice, go for broke, BAT might be appealing. But if you value stability, those consistent returns, there are probably safer bets out there.
You got to know what game you're playing, that's for sure. It's not just about the numbers. It's about the whole story behind them.
Yeah, absolutely. It's like reading a mystery novel. You got to pay attention to all the little clues to figure out what's really going on.
Ooh, I like that. Very good analogy. All right, so we've set the stage here. Declining cigarette sales. A diversification strategy that's still got a lot of question marks. And that dividend yield that could be either a siren song or a legitimate opportunity. But let's get a little more specific here. This Motley Fool article, it mentioned 2 of BP's main competitors, Altria and Philip Morris International. How do they compare? Are they in the same boat?
Well, the whole tobacco industry is facing the same problem, right? Smoking rates are going down globally. So yeah, Altria and Philip Morris are dealing with those same headwinds as Beat. Everyone's scrambling, trying to adapt, find new ways to grow.
So it's not like BT's uniquely disadvantaged here. This is an industry-wide thing.
Exactly. But there are some interesting differences in how they're approaching it. Like Altria, they mainly operate in North America, and that's one of the places where cigarette sales have dropped the most.
Oh, so they're even more exposed to this shrinking market. That's going to make things even tougher for them.
Right. But on the other hand, you've got Philip Morris International. They were actually spun off from Altria. to focus specifically on international markets, so they've got a much wider reach.
So they kind of spread their risk a little more.
Yeah.
Like having a backup generator, just in case.
Exactly. It's all about diversification. Shows how important it is to think about a company's global presence.
All right, so we've got these three players, BAT, Altria, Philip Morris International, all facing the same existential threat, but with different strategies and levels of exposure. Let's zoom back in on BA for a minute and dig deeper into these new categories. What exactly are we talking about here, and how are they performing?
So new categories, it's B-Nate's way of talking about alternatives to cigarettes. So we're talking about things like vaping products, heated tobacco, and those modern oral pouches we mentioned before. Basically, they're trying to get a piece of this growing market for less harmful nicotine delivery systems.
Sounds like they're trying to predict the future of nicotine,
Yeah.
get themselves in a good position. But like we've seen, it's not that easy, right?
Nope, not at all. These new categories, they've had mixed results so far. Those modern oral pouches, they seem to be doing all right. But other parts, like vaping, haven't really taken off the way they hoped.
So even though everyone's saying these new categories are the future, it's not a guaranteed win for BAT.
Exactly. It's still early. And there are a lot of things we don't know yet. Regulations could change, consumer preferences could shift. They've got competition from other companies. All sorts of factors could throw them off course.
It's a risky bet, but they probably feel like they have to make it.
Yeah, they're in a tough spot. They know their core business is shrinking. But switching to these new, unproven categories is a big gamble. It's like the classic innovator's dilemma.
So the big question is, can they actually pull this off? Can B navigate this transition and stay a viable investment in the long run?
Well, that's the million-dollar question. There are a lot of factors at play here. The biggest one, I think, is their ability to execute this new category's strategy. Can they make products that people actually want? Can they get a good chunk of market share in these new areas?
They need to be trendsetters, not just followers.
Exactly. And then there's the whole regulatory landscape. Tobacco is heavily regulated, and the rules for these new categories are still changing. BAT can need to figure out how to navigate that if they want their products to stay on the shelves and be competitive.
It's like playing a game of chess, but the rules are constantly changing.
Right. And then, on top of all that, there's the question of whether consumers will actually adopt these products. Will smokers switch over? Will these new things attract people who wouldn't have used nicotine otherwise?
It's all about changing habits and perceptions, which is never easy.
Absolutely. So BAT's success really hinges on three things. Can they innovate? Can they navigate the regulations? And can they win over consumers in these new categories? It's a lot to ask, but they're definitely going for it.
You know, what it strikes me is it's like baddies trying to disrupt themselves. They're trying to cannibalize their own business with these new categories. It's bold, but also kind of necessary given the situation.
Absolutely. It's textbook disruptive innovation. They're acknowledging that the old ways are dying, and they're trying to create the new. Will they succeed? Who knows? But it's a fascinating story to follow.
And for investors, it's a story that requires careful consideration and a clear understanding of the risks. So we've laid out the challenges, the strategies, the potential pitfalls. But to really understand BAT's prospects, we need to take a look at their financials.
That's a great point. The numbers tell a story. And in the next segment, we'll be diving into BAT's balance sheet, their debt levels, and their overall financial health to see if they really have the resources to pull off this ambitious transformation. Welcome back to our deep dive into British American tobacco.
So we've spent some time unpacking BAT's situation, the shrinking cigarette market, their move into these new categories like vaping and smokeless tobacco, and of course that big 8.1% dividend yield.
Yeah, it's a complex picture for sure. A company trying to, reinvent itself while still relying on a product that fewer and fewer people want.
Exactly. It's like, trying to juggle chainsaws while riding a unicycle. It's ambitious, for sure, but also, pretty risky.
That's a great analogy. And it brings us to a pretty important question. Can BAT actually afford to do all this? Can they invest in these new categories while their core business is, shrinking?
Let's get into the numbers a bit. We know cigarette sales are dropping, but what's the overall financial health of the company? Are they in a good position to make these big bets on the future?
Well, BAT's not some tiny startup, right? They're a massive, well-established company with deep pockets. Even with cigarette sales declining, they're still bringing in billions of dollars every year.
So they're not exactly struggling to make ends meet.
Not yet, at least. But there are some warning signs. This article pointed out that BAT has a pretty significant amount of debt, like their debt-to-equity ratio, which is basically a way to measure how much debt a company has compared to its equity. It's higher than a lot of their competitors.
Okay, hold on a sec. Debt-to-equity ratio. Can you break that down for those of us who aren't, financial experts?
Sure, think of it like buying a house. You put down a down payment, that's your equity. Then you take out a mortgage, that's your debt. The debt-to-equity ratio just compares those two numbers.
So a higher ratio means more debt compared to equity.
Exactly. And in Beth's case, that high ratio suggests they've been borrowing a lot of money, which can be risky, especially if their profits start to drop.
So it's like they're building a bridge to the future, but using a lot of borrowed materials.
That's a good way to put it. And that leads to another interesting point from the article. Betsy has actually been using some of that borrowed money to fund their dividend payouts and share buybacks.
Wait, hold on. They're taking on debt to pay dividends? Is that kind of like using your credit card to pay your rent?
It can be, yeah. Some analysts are saying that Betsy's dividend isn't sustainable and that they're basically borrowing from their future to keep investors happy right now.
That's a little concerning, isn't it? It's like trying to outrun a storm by running in circles. You might feel like you're getting somewhere, but you're just exhausting yourself.
It's a tough balancing act. They need to keep investors happy with those dividends, but they also need to invest in the future if they want to survive this shift away from cigarettes.
So what are the experts saying about all this debt? Are they worried or are they optimistic?
It's a mixed bag, really. Some analysts think Batty's debt levels are manageable. They say they have enough financial strength to make this transition. They point out that Batty is still generating a lot of cash, even with cigarette sales declining, and that they've been cutting costs to improve profitability.
So they see it as a calculated risk, not a reckless one.
Yeah, you could say that. But other analysts are more skeptical. They worry that all that debt could become a burden, especially if these new categories don't grow as fast as Batty hopes.
So there's a chance they could end up, drowning in debt.
Exactly. It's a high-risk, high-reward situation.
Yeah.
If Batty can pull off this transformation, they could become a leader in this new generation of nicotine products. But if they fail, all that debt could come crashing down on them.
So it's not a sure thing either way. There's a lot of uncertainty about Beat's future. What are some key takeaways for our listeners? What should they keep in mind when thinking about investing in a company like this?
I think there are three big things to consider. First, like we've been talking about, Bay's facing a huge challenge. With the shrinking cigarette market, this isn't a temporary thing, it's a long-term trend. And it's unlikely to change.
Like the tide going out. You can try to swim against it, but eventually you're going to get swept away.
Right. Second, while these new categories have potential, it's still very early days. There's no guarantee that these new products will be successful or that Bait will be able to compete effectively in these new markets.
It's a lot of ifs, maybes, and what ifs.
And finally, that big dividend yield. While it's definitely tempting, could be a sign of trouble. It might mean that they're focusing more on keeping investors happy in the short term, rather than making sustainable decisions for the long term.
So don't just get dazzled by that dividend. Look at the bigger picture and consider the fundamentals of the business.
Exactly. Investing is about making informed decisions, not chasing quick returns. And with B, there's a lot to think about before you jump in.
It sounds like BD's situation is kind of a microcosm of what a lot of established companies are going through right now. They're getting disrupted by new technologies, changing consumer habits, all these new regulations.
It's the age of disruption, for sure. And if you can't adapt fast enough, you're going to get left behind. Look at what happened to companies like Kodak and Blockbuster. They didn't see the changes coming, and they paid the price.
It's a reminder that even the biggest companies can fall.
But it's not all doom and gloom. B8 is trying to reinvent themselves. They're not just sitting there waiting for the end. They're taking risks, making big bets, trying to shape the future.
It's like watching someone walk a tightrope across a canyon.
Yeah, it's nerve-wracking, but also pretty impressive.
And whether they'll succeed? Well, we'll just have to wait and see. So for our listeners who are interested in Beast Tea, but maybe a little hesitant because of the risks, what other options are out there? Especially if they're still interested in those dividend payouts, should they be looking at other companies in the consumer goods sector?
That's a great question. It brings us to a really important concept in investing: opportunity cost. When you decide to invest in one company, you're also deciding not to invest in another. So it's important to think about not just the potential upside of one investment, but also what other opportunities you might be missing out on.
It's like choosing between two desserts. You really want that chocolate cake, but if you choose it, you can't have the apple pie.
That's a great analogy. So if someone decides that BAT is too risky, but they still want that dividend income, there are lots of other options to consider, especially in the consumer goods sector.
Like what kind of companies?
Well, one approach is to look at companies that make essential goods, things that people use every day, no matter what's happening with the economy. Things like food, beverages, household products, personal care items.
So the stuff you see advertised on TV all the time.
Exactly. These companies tend to have very stable earnings because people always need these products.
It makes sense. People still need to eat and brush their teeth, even if they're not buying a new car or going on vacation.
Right. And a lot of these companies have a long history of paying dividends and increasing those dividends over time.
So they offer both income and the potential for growth.
Exactly. And their yields might not be as high as BAT's 8.1%, but they tend to be a lot more stable and predictable.
So you're trading some potential upside for a little more peace of mind.
So that's a good way to put it. It's all about finding the right balance between risk and reward for your own personal needs and goals.
Okay, so let's say someone's ready to start looking into these consumer staples companies. What advice would you give them? Where should they start?
I'd say start by focusing on companies with a solid track record of paying dividends, companies with a history of profitability, and a manageable level of debt.
So basically, companies that are financially healthy
Mm-hmm.
and have a proven ability to make money and share it with their investors.
Exactly. Look at their dividend payout ratio, which is the percentage of their earnings they pay out as dividends. A lower ratio means they have more room to increase dividends in the future.
And of course, always do your research. Don't just rely on headlines or what other people are saying.
Absolutely. Read company reports.
Yeah.
Analyze their financial statements. Understand their competition. And think about their long-term prospects.
It's like buying a house. You wouldn't just drive by and make an offer, right? You'd want to get an inspection. Check the foundation. Make sure everything's in order.
That's a great analogy. Investing is a lot like buying a house. You're making a big financial commitment, so you want to be informed and confident in your decision.
So, to wrap things up, we've taken a close look at British American Tobacco, a company at a crossroads. And we've discussed some alternative options for investors who are looking for dividend income.
The important thing to remember is that investing is a personal journey. There's no one right way to do it.
What works for one person might not work for another. It's all about understanding your own goals, your risk tolerance, and your financial situation.
And never stop learning. The world of investing is constantly changing, so stay curious, stay informed, and most importantly, don't be afraid to ask questions.
This has been The Deep Dive. Thanks for joining us. All right, so welcome back to our deep dive into the world of dividend-paying stocks and all the things you got to think about when making those investment decisions.
We've spent the last 2 segments taking a close look at British American Tobacco, or BAT, a company that I'm sure caught your attention with that high dividend yield.
Yeah, 8.1%. It's hard to ignore, especially when you compare it to, most yields that are around 2%.
But like we've talked about, there's more to it than just the dividend. BIT is facing some serious challenges, like those declining cigarette sales, and that risky move into new categories like vaping and smokeless tobacco.
Exactly. It's like trying to build a boat while you're already out at sea in a storm. Ambitious, yeah, but definitely risky.
It is, and that brings us to a really important point for any investor, no matter how much risk you're comfortable with. Diversification.
Right. We talked about opportunity cost earlier. When you choose to invest in one company, you're also choosing not to invest in others.
Exactly. So if you decide that BAT's risks are just too much for you, but you're still interested in dividend income, it's worth looking at some other options, specifically options that might have a similar yield but with a different level of risk.
Okay, so let's say you're interested in those consumer staples companies we mentioned. For dividend income, what are some examples that might fit the bill?
Well, I can't give specific investment advice. Everyone's situation is different, but I can offer some general guidance, point you in the right direction.
Perfect. Let's brainstorm a bit.
Remember, we're looking for companies that produce essential goods, the kind of things people buy no matter what the economy's doing. Food, beverages, household products, personal care items.
So basically the stuff you see in every commercial break on TV.
Exactly. These companies tend to have really stable earnings because people always need these things.
Right. It makes sense. People still need to eat, brush their teeth, even if they're not buying a new car or going on vacation.
Exactly. And a lot of these companies have a long history of paying dividends, and they tend to increase those dividends over time.
So you get income now and the potential for growth later.
Right. And their yields might not be as high as BT's 8.1%, but they're usually much more stable, more predictable.
So less potential upside, but more peace of mind.
That's one way to look at it. It's all about finding that balance between risk and reward. That works for you.
Okay, so if someone's ready to start looking into these consumer staples giants, what advice would you give them? Where should they start?
First, I'd say focus on companies with a strong track record of paying dividends. Companies that have a history of being profitable and that have a manageable level of debt.
So basically, companies that are financially healthy and have proven they can make money and share it with their investors.
Exactly. Look at their dividend payout ratio. That's the percentage of their earnings they pay out as dividends. A lower ratio means they have more room to increase those dividends later on.
And as always, do your research. Don't just rely on headlines or what you hear from other people.
Absolutely. Read the company reports, analyze their financial statements, understand their competition, and really think about their long-term prospects.
It's like buying a house. You wouldn't just drive by and make an offer, right? You'd get an inspection, check the foundation, make sure everything's good.
Great analogy. Investing is a lot like buying a house. It's a big financial commitment. So you want to be informed and confident in your decision.
So to wrap things up, we've explored British American Tobacco, a company facing a really crucial moment. And we've discussed some other options for investors who are looking for dividend income.
The main takeaway here is that investing is personal. There's no one right way to do it.
What works for one person might not work for someone else. You got to understand your own goals, your own risk tolerance, your own financial situation.
And never stop learning. Investing is constantly changing, so stay curious, stay informed, and most importantly, don't be afraid to ask questions.
This has been The Deep Dive. Thanks for joining us.